Is Verizon a buy or a sell? Let's get started with the model. This is a large cap company, 174 billion market cap. They're trading at $41 a share, and they have 4.2 billion shares outstanding. This company offers mobile phone, home telephone, and internet services. In terms of revenue, they're the world's second largest telecommunications company, and their mobile network is the largest wireless carrier in the US with 114 million subs. Still less than Mr. Beast. Let's look at their financials. The way you value a company is you estimate the free cash flows into the future and then you discount those numbers back to today's value. That's what we're doing in this video. And free cash flow is cash flow from operations minus capital expenditures. Look at 2021, negative 28 billion of free cash flow. That's a rough year. It did improve, positive 10 billion in 2022, up to 13 billion in 23, up to 14 billion in the trailing 12 months. Net income is the profit or loss on the income statement. It's revenue minus expenses. That goes from 22 billion all the way down to 10 billion. It's a big drop. Revenue is a sales for the company, and that's flat. It goes from 134 billion to 134 billion. No growth at all. Pretty much the only reason people buy the stock is to get the dividend. They pay a really high dividend, 6.5%. And they could afford that. It cost them 11.4 billion, but they generate almost 14 billion of free cash flow, so they can cover the dividend 120%. We estimated 4 years of future free cash flows. We also estimated a terminal value, which is all cash flows past year 4, that's 240 billion. We discounted those numbers back to today using the weighted average cost of capital. We get a value of the company of $215 billion. We divide that by 4.2 billion shares. And we get a calculated stock price of $51. They're trading at $41, so they're trading at a 19% discount. It's a buy according to the model. Do you think it's a buy or sell? Let me know in the comments. There are 41 companies in the same industry as Verizon, and if they have a number in red, they're worse than the median. If they have a number in blue, they're better. They spend the most in CapEx. These are the investments in property, plant, and equipment. Telecom companies spend a lot in building out their infrastructure. Lots of cables, underground, overground, lots of man hours. Nearly double T-Mobile. They are a bit leveraged. Their debt to equity ratio is 1.8, which means for every dollar of equity they have $1.80 of debt. Same as T-Mobile. Comcast is 1.2. Vodafone is 0. CHT is Chunghwa, a Taiwanese telecommunications company. They pay a really nice dividend, 6.5%. Look at Vodafone, 10.5%. And BCE, all our friends to the north in Canada, they get a sweet dividend as well, 10.5%. AT&T is number 1 in free cash flow, 20 billion. Verizon's number is pretty close to T-Mobile. They rank second in market cap, really close to Comcast. T-Mobile is easily number 1. Price to book is equal to the median. The UK company Vodafone has the best price to book at 0.4. Price to book is stock price over book value per share. They have a nice PE, 18, better than the median. Charter Communications is the best at 10.3. Charter is a US company headquartered in Stamford, Connecticut. Vodafone has the best price to free cash flow. They're trading at 2 times free cash flow. Verizon is 9.4, which is a pretty good multiple. That's stock price over free cash flow per share. Verizon has good price of sales, 1.3. Look at their revenue, 134 billion. That's more than T-Mobile, Comcast, AT&T, and Charter combined. But their 5-year annual revenue growth rate is 0. That's why people aren't buying the stock, and it appears really undervalued, according to their price multiples. Liberty Broadband is number 1 at 133%, so they're growing a ton. If you put $10,000 into this company 10 years ago and reinvested the dividends, you'd have $13,600 today, a 3% annual return, a 36% total return. Not a good return on investment. To summarize, I have them trading at a 19% discount, ranking 6 out of 10. It appears like it's a good value. Would I buy it? 4 out of 10. I'm not a big fan of this company. Way too much debt. Ratio 7 out of 10. Really nice price multiples, especially the price to free cash flow. Financials 5 out of 10. It's not that great. I mean, their free cash flow is improving. It went from 10 billion to 14 billion, but their revenue is flat. It's not going anywhere. It's actually gone down since 2022. Let's look at their 10Q they just released. Revenue is flat. Look how close their revenue is from last year, almost identical. 33.3 billion to 33.3 billion. And they give a breakdown of their revenue. Service revenue, 28 billion. Wireless equipment, 5.3 billion. Equipment is down while service is up. Of the 33.3 billion of revenue, 25 billion is consumer, which is almost identical to last year. Business is down 7.5 to 7.35 billion, down 2.3%. Corporate is up 11%, but it's a pretty small part of their revenue, 680 million. Below revenues are operating expenses. Cost of services, 7.2 billion. So those have good margins. 28 billion of revenue, cost of revenue, 7 billion. They're actually losing money in equipment sales. Revenue 5.3 billion, cost of revenue 6 billion. But this is a loss leader. In order to get the service revenue, they have to sell equipment. I mean, they don't have to sell it, but it helps. If they sell the equipment, people are probably locked into contracts. Or it's just easier to go with them since it's their equipment. SG&A is 10 billion, that's up a lot. It was 8 billion last year. If you want to learn what's part of SG&A, it includes salary, benefits, taxes, but not income taxes, advertising, sales commissions, professional fees, rent, utilities. So it's most of the expenses that are not directly tied to generating revenue. They have a lot of fixed assets, so depreciation is 4.5 billion, total expenses 27 billion. That's up a good amount from last year. Operating income, 6 billion. It was 7.5 billion. They have a lot of debt. They spend 1.7 billion of interest on their debt. Pre-tax income, 4.3 billion. Taxes, 900 million. So net income, 3.4 billion. Their EPS is down. It was $1.13. Now it's 78 cents. EPS is earnings per share. You take the total earnings, the net income, over shares outstanding, which are 4.2 billion. A little more than last year. Last year, they had 9 million less shares. So they may buy back stock, but they're adding more stock than they're buying back. Let's take a look at the balance sheet. Their current assets, 41 billion. Current assets are assets that can be liquidated into cash within 12 months. And it starts with the most liquid, cash. Then the next most liquid, accounts receivables. This is when they sell something on credit. They have a lot of accounts receivables, 27 billion. Some of those accounts receivables won't be collected, so they report a credit loss of 1.1 billion. So their net accounts receivables is 26 billion. When they record this credit loss, it brings down their net income on their income statement. So before they actually take the loss, their net income goes down. If the loss they recorded is too high, they didn't need that, then they would reduce this on the balance sheet and pass through a gain onto the income statement. They have 2.5 billion of inventory. Then you have 7.2 billion of prepaid expenses. Our prepaid expense is when you make an advance payment for a product or service you're going to receive in the future. Like if you paid 1 year of rent up front, that's a prepaid expense. It would sit in the balance sheet, and then each month you would remove part of that asset and pass through an expense onto your income statement. PP&E is really big, 108 billion. So the gross value, how much they originally paid for the PP&E is 328 billion. They depreciated 220 billion. So the balance sheet records original value minus depreciation, the book value. Licenses is their biggest asset, 156 billion. The way they obtain these licenses is through the FCC, the Federal Communications Commission. Wireless companies have to buy FCC licenses from the government in order to charge us for using wireless services. They definitely do their fair share of acquisitions, 23 billion of goodwill. I know they're working on a big one right now with Frontier. They talk about it right here. It looks like in September they started the process to acquire Frontier. Here's some more info on Frontier. They're in 10 million homes, 2.2 million subscribers, over 25 states. Half of their revenue and 65% of their EBITDA is from fiber. Once they add these 2.2 million fiber subs, that'll bring Verizon up to 25 million across 31 states and DC. It looks like they're going to pay $20 billion for the acquisition. This will be one of their bigger acquisitions, maybe top 10. Let's go back to the balance sheet. Total assets 380 billion, liabilities 220 billion. Their biggest by far is long-term debt. They have more debt than almost any company in the world. They're probably top 10 in debt. This is as of 2023, companies with the most debt. Toyota is number 1. Evergrande is number 2, the Chinese real estate developer. Another car company, Volkswagen. And he has Verizon, then Deutsche, the German bank. Ford. Car companies love debt. SoftBank, the Japanese investment firm. AT&T, Deutsche Telekom, and France Electric. Assets minus liabilities equals equity, 98 billion of equity. They raised 13 billion from selling their business. They profited 86 billion from running their business. Let's take a look at the statement of cash flows. The first section is operating cash flow. Even though their net income is 13 billion, they generate double that in cash flow because they have 13 billion of depreciation. And they spend 12 billion in CapEx. These are the investments in property, plant, and equipment. And they had a cash outflow of 11 billion in their financing section. They add a lot of debt, 11 billion, and they paid back a lot of debt. 6 billion and 6 billion. The 8 billion is dividends. Let's look at a stock on Simply Wall Street. Its last price, 174 billion market cap, down 4% in the past week, up 17% in the past year. Look at this stock chart since 1990. It was $23 a share. That's when they started trading. And they reached their peak in 99, almost 70 bucks. It never got that high again. The stock is all over the place. Look how much it's gone down, then up, then down, then up. The thing is, you still get a nice dividend. But if you bought it north of 40, then your yield isn't so great. But if you picked it up, even over here at like 30, 35, you're probably doing really well in dividends. Especially when the stock price got higher, they probably raised their dividend. Even though it's come down to where you bought it, you collected a lot of dividend payments along the way. Simply Wall Street is really bullish on this one, 147. They say the stock is 72% undervalued. The reason Simply Wall Street's target is so high, because look at a whack, 6%. I think I use like 11% on my model. This company has so much debt, 6% is way too low. 23 analysts priced this stock at 47. That makes a lot more sense. And their revenue barely budged since 2013. It was 120 billion, now it's 134 billion. No growth at all. And the reason a lot of people don't like the stock is because of all the debt. It was over 90 billion in 2013. It got up to 158 billion in 2021, and it's still around that point. And their equity is usually lower than their debt. I think the gap has gotten a little smaller, but not by much. Their debt to equity ratio was over 800% in 2014. Now it's a lot better, 156%. But it's been between 1 and 200% for a while. Actually over 200% at a couple points. Right here at 202%. And they don't have that much cash on their balance sheet, only 5 billion of cash. They do pay a nice dividend. It's always at least 4%. And last year was almost 8%. It's come down a little bit because the stock price has come up. But the forecast is 6.7% by 2026. But if you bought the stock at a discount, that means your cost basis is lower. So your yield might be 15-20%. Some people might have a yield close to 60-70%. CEO salary in 2017, 800,000, now 1.5 million. Total compensation, 24 million. Tenure as CEO, 6.2 years. His salary percentage is 6.2. The way you calculate that, it's 1.5 million right here over 24 million. Tenure 6.2 years, salary 6.2%, and he's 6'2". His board tenure is almost 6'2". It's 6.1 years. Next month it'll be 6.2 years. In the past year, no insider buying, a couple of sells, both by Kyle Milady. He runs one of their business units. 64% of the company is owned by institutions, 35% by the general public. And their biggest shareholder is Vanguard, not far behind is BlackRock. You got Schwab, Morgan Stanley, BNY, Fidelity, Eaton Vance, RBC. Their employee count has gone down a lot. You don't like to see that. It was 177,000, now it's 105,000. And the ticker trades on the New York Stock Exchange, Mexican Bolsa, London Stock Exchange, the Bern, Deutsche Börse, Zitra, Santiago, EuroTLX, Wiener Börse, Lima Bolsa, Bulgaria, Kazakhstan, BATS Europe, Buenos Aires, Sao Paulo Bolsa, and NEO. So if you want to learn how to dig into financials and become an expert like me, click on the video in the top right corner. Thanks for watching.